it's such a clear indicator that Citigroup is not like the others. Sorry if Steven's gone, but I'm going to continue for a second.
I know what happened. He probably tried to take down the chart and he just closed the whole window.
Yeah, that's exactly. He just left.
I know that's what happened.
This is Stever's boomerness coming out. Yeah, it's like,
yeah, he clicked the one red button.
Sorry, Tannor, go ahead.
No. But all I'm going to say is that if I know Warren Buffett just made a.
You figured out how to use a computer, huh?
You know what? I'm buying a freaking camera, I'm mounting it on my fucking wall, and I'm using my main computer, not a stupid laptop for this stuff. And I'm using a laptop.
You literally have to press one button and you would have everything.
Yeah.
And by the way, to that one viewer who recognized that I got a new mic, thank you. I love
Oh,
this
it's
mic.
there. The sure is. I didn't even see it.
Yeah, this mic is amazing. Like I
a real podcaster now.
Cheers,
Wait, so are three of you are on the same mic now?
Yes.
Yes, sir. But I sound the sexiest out of all of them.
Tevis, what do you have?
Well, I'm traveling, so I have just a little lapel mic right here.
okay.
But normally I have the shitty Yeti.
I've told Steven multiple times that the Yeti, the top is not actually where the audio is recorded. It's at the front for the Yeti, but he keeps pointing it at his face.
What's the front? Where's the front?
Like that. No, okay. First of all, okay, you have it turned around.
Okay. Well, look, I don't know these things. What do you want from me?
Definitely get banking advice from Steven, but don't get advice on picking on Mike. Definitely.
I know you're in all the value stocks just from the last 2 minutes of seeing how you handle technology.
Yeah. No, he has a bunch of growth.
Welcome to Amit, Steven, Tannor, Kris, and Tevis's podcast of SoFi Weekly.
Well, I'm starting to see what you guys are doing. I had a lot of questions about SoFi, but as I'm doing more research and deep diving in, I'm starting to see what you guys are seeing.
Christopher Patel, you have made a purchase of SoFi. I'm actually going to pull up your tweet where you announced it to the world. You have been the biggest skeptic that is more bearish than not on the company, and that changed 3 days ago. What changed and why are you now a bull on SoFi?
One of the biggest concerns I've always had about SoFi was their personal loan book. If you really look at the interest rates that get charged for personal loans, they're like almost double digits. Like people looking to build wealth don't do it through personal loans. I understand that there are times where people could get into some credit card debt and then they end up consolidating using personal loans. But to be honest with you, not too many people that I know are in that position. What I have seen a lot is people using personal loans as bridge loans, and that's perfectly reasonable, but the rate at which they're paying is just nuts. So when I see a company go overly expansionary when it comes to personal loans, it worries me because it's one of those areas that personal loans are unsecured debt. There's nothing really backing these personal loans. At least with other types of loans, there's assets behind it, whether that be, houses or property or some sort of collateral. Personal loan is just me giving you money and hoping that I get that money back. And a lot of times they have to like juice up the interest rate so much because the amount of people that typically default on these personal loans is relatively high. And so as the economy starts to go down, those personal loans typically are a big nuisance on companies' balance sheets. But one of the things that really changed my mind is as I started to dig a lot more deeper into the client base that SoFi has. And what really set it for me was the concept of a Henry. I heard it mentioned on SoFi Weekly first. So then I really started to dig deep into that Henry concept. A Henry is a high earner. What is that?
Not rich yet.
Not rich yet. Yeah. So it's people like your doctors, your nurses, people who work on in certain fields where, they just have a lot of income, but at the same time, their expenses are up there also. So I was watching How to Become a Millionaire or How to Become Rich on Netflix. And what I saw was majority of the people on there, they had some form of personal loans. But if you look at their income, it was really high income. We are in a society where personal finance isn't necessarily taught as much. And I need to dial back my pessimism when it comes to personal loans, because I feel like as long as you have good credit quality borrowers, they'll be fine. And as long as you are actually adjusting your rate of return to allow for a certain level of defaulting, you should be fine. After I did research on that, I really did a deep dive on Anthony Noto and the management team. These are former Goldman bankers. These are guys with Harvard MBAs. These are not like your run-of-the-mill, went to some junior college somewhere and decided one day, hey, let's do an electronic bank. These guys are killers. And as I deep dive into their pedigrees, but also their experience, they come from large banking experience, which means that they have the ability to scale up and bring that same level of knowledge to the SoFi community. And
the stock dropped to 440 on Monday. Did that have anything to do with you looking even deeper to establish a position?
Yeah, in general, I think financials are very undervalued right now. You know, majority of them are trading under book value. Their PEs have dropped off significantly. So right now, financials are a big interest to me. And as I look through SoFi at $4 and something, the risk premium is on your side. There's not really much downside you can go after this. $4 at a $4 billion market cap with assets that are in the $15-20 billion with liabilities that are manageable. And at the same time, you have a depositor base that's getting bigger and bigger. Noto and team could literally do profitability like this. Okay. They can just snap their fingers and become profitable overnight, but they choose not to. And the reason why they're choosing not to is they are going after as much market share from the traditional banks as possible. So they are eating the short-term pain. They want to get as many people on their platforms as possible because people are creatures of habit. And once you get them into your ecosystem, it's really hard to get people to switch out. Like me, I've had TD Bank for the last 20 years. TD Bank treats me like shit. All right. Barely get any interest, but you know why I stay with them? Because I'm too lazy to switch all my auto payments and everything. And I'm like, yeah, I'll get to it next Tuesday and blah, blah, blah. But here's the thing. If I end up signing up with SoFi, I'm probably going to be a member of SoFi for the next 30, 40 years. So I just think that right now they are in growth mode. They're willing to sacrifice short-term profitability to get there. They also don't do a dividend. All these other banks, they have dividends that they have to pay their investors. If they don't pay their dividends, investors will dump their shares. SoFi doesn't have to pay a dividend. They're fine right now in growth mode. So honestly, at this point, SoFi at this price, just it's a no-brainer. It's like, to me right now, it's just an easy double without even like trying. Once they hit gap profitability by the end of the year, which is what their target is,
The sucker's going to run.
you're going to see a similar thing happen with Palantir. So Palantir was all about, hey, this is a failing software company. It's not growing X, Y, and Z. But the minute they turned on the spigots of profitability, everyone and their mother started jumping in, including other funds and everything. Q4 comes, they show profitability, net income, gap profitable. They're going to have a PE. PE is going to be high, but you're still going to have a positive PE, which means a lot of companies are going to, a lot of funds are now going to be willing to put money into them. And by that time, they'll have captured a good amount of market share too. So
Kris, let me ask you this now. Now that you bought, is this something that you want to just double up right out in the fairly short term, hold long term? Like, what's the strategy there?
To be honest with you, I think this is a long-term play for me. Is there a price where if it runs too quickly, I will sell a little bit? Yeah. If it goes up tomorrow and 80%, yeah, you should be smart and say, let me take some money off the top of the table. So this way I have enough when it does pull back after a short run, I have enough optionality to get back in. But if it's a slow, steady grind higher, I think this is one of those companies that I wouldn't mind holding for 20 years. And I think they have the ability to be a JP Morgan. I mean, you guys see this as some kind of like fintech. I see it as a bank. All right. I value this thing like a bank, but they're an excellent bank. That's the point.
So Galileo didn't play a role in your due diligence at all?
Fine. That means you get it for free.
Exactly. It's just a cherry on top. Think of it as this is a bank. What do banks do? They borrow short, they lend long. These guys have all this money coming in short term at cheap capital rates. They're literally paying 4%. If you go to any bank right now, go to FINRA's website and look at how much they're paying on their debt. It's 7, 8, 9% on their long-term debt that they've issued. SoFi right now, because of their captive audience, they're getting all this extra money at 4%. They're going to be lending money to other people at 7, 8, 9% and make a killing on the spread. They're going to have these longer term loans. Once interest rates start going down, those loans become really valuable. SoFi is not a river. It's like a whole bunch of streams leading into the ocean. Like I said, I see over time, all those streams just piling in, and eventually it'll be a giant body of water.
It's who's going to have the best flywheel and mousetrap in the future. Their critical success factor is grabbing as many people as they can, entering the workforce, getting out of college. That's sweet spot because they have a huge trajectory of growth. And younger people, they want everything seamless transaction, and they want everything in one place, like Kris said. They don't want everything parceled out. They don't want to have to go to multiple things. We are a society of instant gratification now. And that's been part of my thesis the whole time, that I do think SoFi has developed the best ecosystem over the past 2 years because they were forced to adapt. And when you see a management team that can have their largest line of business taken away from them at a moment's notice and pivot and do everything else very well to make it where they continuously increase their guidance, it's just telling of the management company and how the membership values its products. I think there's a long flywheel of growth there.
Just remember, you guys have a former Goldman banker running your thing. All right. He grew up under the leadership of Lloyd Blankfein. Lloyd Blankfein was was a goddamn shark.
You look at their board.
Yeah, man. The entire board is stacked with freaking killers. Like that is in terms of like a team, you could not craft a better team of people to run a bank for growth and for profitability. Like it's loaded with a bunch of goddamn killers. Like their pedigree of their board members is just nuts. Like they have a strategy to take it all. I'm more bullish on SoFi than I am on Palantir. I'll be honest. But the point is, they have a leadership team that knows how to execute, that has management experience in dealing and navigating rough waters. Like if you had a bullshit CEO at SoFi, I wouldn't touch it. I'd be like, that's too speculative. But if you guys know that if you have an operator who knows how to run a business and not only run it at like a small level, but run it at the investment banking level, you're gonna be on another level of profitability. And I think. Yeah,
is your position fully built out right now, or are you looking to buy more? Like what?
I will probably buy more. I'm probably going to be adding throughout the course of the year. You know, right now, like I said, I think financials overall are very undervalued. Even if, let's say, SoFi just performs normally and financials all start to ride up.
Yeah, Kris, are you concerned at all with the weakening job market, increasing defaults on loans? I know you said 4% is current, but that could easily increase rather quickly in this macro environment.
So unfortunately, I don't think we are going to see the level of unemployment that a lot of people are thinking. Like
we're not doing 4.5%.
No. Well, the whole thing of getting us into a recession was to control inflation. But the end goal is not, hey, we need to get 5% of the population unemployed, because that right there, it's bad. You don't want to hurt people. I know that is one of those things that you could do, but I think inflation is coming down so fast, so rapidly right now that you don't necessarily need that many people to be unemployed. The labor market is just really, really strong. I do think that there's going to be some material weakness, but not enough. And the credit quality of SoFi's borrowers speaks for itself. And that's going to be their biggest moat. You have people like Lending Club and all these other ones. They're bottom feeding, right? They're like, we will give loans to a lot of people, whether or not they deserve it or not. You know, SoFi is specifically targeting certain career paths that are insulated from recessions. Like healthcare workers is like one of the areas where I think that they have specifically geared a lot of their members towards, right? My wife, she's a healthcare worker. She's a pharmacist. And when we first got our mortgage for a condo, my wife has loans. She's got 190,000 student loans. But SoFi didn't look at that and say, oh, that's a big negative. They said, no, you know what? You make all this extra money because you work in healthcare. You can very well pay your money and also do your mortgage. So we actually had a SoFi mortgage for I think like 5 years until we refinanced.
Well, it also makes sense, just interesting timing on the trade, right? Or at least on the buy for SoFi, because we got the most accurate numbers in Q1. We know that the Fed isn't going to raise anymore, and we can get a more accurate landscape of what is it, like how bad is this going to look 6 months or 12 months down the line to a certain degree. And the cherry on top is SoFi is trading at, all-time lows. It seems like the juice is worth the squeeze at this point.
The only pushback against that is based on Powell's comments today. Now investors are pricing like a 39% chance that we do get 25 basis points. Noto and team thinks there's going to be 2 rate cuts by the end of the year. I want to believe them, but I don't know if that's happening either.
No, the bond market's already telling you that that's in the works. Like there's no way around it. I think today I was paying attention to Powell when I should have been paying attention to goddamn Yellen. Yellen is the one that screwed us over today. Yesterday, Yellen had a meeting with a whole bunch of the bankers, and basically she said, hey guys, maybe you guys better be ready because there may be some more bank mergers coming, which means that there might be some weakness that's going to show up at some of the other regional banks. So all the regional banks all at the same time, and especially financials, now that we're always buying indexes, they all collapsed at the same time. A lot of what the Fed says and what they actually mean are two different things, because the economic data that's coming out is actually showing you that inflation is coming down significantly, whether you're looking at it from a core PCE perspective or just a general top line CPI. I think financials over the next 2-3 years are going to do exceptionally well. I wouldn't be scared of the short term. I'd just be heavily diversified in my regional bank portfolio. But more than that, I'd look at the companies that are going to benefit from the fallout of the regionals.
What would be the 1 to 2 catalysts in the next 6 months that make financials rise up?
Lower interest rates. The minute they start lowering interest rates, all the assets that's sitting on everyone's balance sheet that they've marked down fair value automatically get marked back up. And then your price to book value makes absolutely no sense. then your risk-free adjusted, like right now, every bank is, you know who their biggest competitor is? Every single bank's biggest competitor.
No, the treasuries.
Exactly. It's the fucking treasury. Right now, if you're getting a risk-free 5.25%,
I'm guilty.
that would suck to compete against Uncle Sam right now. That's who you're competing against. But the minute Uncle Sam says, hey, listen, I'm putting my hands up, I'm lowering interest rates, all that money is going to be rushing back into the banks, trying to get higher rates of return, trying to put more money into different investment vehicles. Also, don't forget, if depending on what your income tax bracket is, the treasury is giving you that money tax-free. It's tax-free return, right? Whereas if you go
level.
on the federal level, it's tax-free return, which is amazing because if you're at like me, I'm in one of the highest tax brackets. I'm paying up the wazoo for taxes. So I would need to make a risk-free adjusted return of almost 8% to make an investment worthwhile. So that's who you're competing against right now. But the minute those interest rates start coming down, bro, SoFi is going to hit another level of profitability, and Noto's planning exactly for that. So,
and when rates go down, this new acquisition is going to look real good after it gets fully integrated and broken out. Because now you're going to have the housing market start to heat up because people aren't, look, right now, people are not leaving a 2.5% to 3.5% mortgage to go take a mortgage at 6.5%, 7%. It's just not happening unless you have to move.
$2 price target was this week or last week?
It was on the 14th.
That's what fucked the price, right? Okay, so we should talk about it then.
It was like on Monday, wasn't it?
No, it was on the 14th.
You're right. It was on Monday.
What are we looking at here? So all of the things since the Q1 earnings, you can see that the person with the lowest analyst rating, David actually used to be an amazing analyst. He was a 5 out of 5 star. He's had a very bad track record since like 2022. So he actually does have a very good track record since then. If you look at everyone else has a better rating than him on this list. 5 out of 5 stars, 3 out of 5, 2 out of 5. Dan Delev is who Kris said should be the SoFi hero, putting a $9 price target on this stock, gave a really good reasoning for it, but also he doesn't have a very good analyst rating. I don't know. Regardless, like you can see at the bottom here, the average analyst price target. Now, I don't put a lot of weight on analysts, but still, it is good to know that people's full-time jobs covering this stock and in a myriad of other positions are putting this price target at $7.25.
All right. Do we want to move on to the biggest fintech of this week and its collapse? PayPal?
I'm doing a lot of deep dive. I don't know if you guys heard of FedNow and how scary that shit should be for PayPal.
Honestly, I'm not too worried about FedNow and PayPal. I mean, they can integrate it with their own solutions, and they can offer other products like lending services and stuff. What FedNow is a direct bank-to-bank solution for payments, 24/7, 365, no fees.
No, they have fees. They're just really, really low fees compared to the clearing fees that you're going to be paying at MasterCard, Visa, and all these other.
Well, they're not they're not doing it for profit. You know what I mean? So I was reading a lot of these large banks might not even take FedNow. It's a opt-in solution that a lot of them don't need to actually use. And then even in that case, I mean, I don't necessarily believe that PayPal will be 100%, destroyed because of FedNow.
If you can make direct payments without the need for an intermediary, which is what PayPal is, how wouldn't that disrupt them?
Yeah, but
it's all backed by the Fed, right? Like it's all secure and there's a level of trust there as well. And you have lower fees and you have faster transactions and you don't need an intermediary.
I don't think that's PayPal's large business anymore. I think it's checkout. I think it's all these things. There's a lot of services like their lending services and them to offer a bunch of integrations with large institutions. I mean, that's a lot of their moat right now.
But Kris, why are you worried about FedNow?
Because it limits other people's upside. Even though maybe somehow Visa, MasterCard, they figure out a way to compete against all the positives that Tevis just told us, because that's what it is. It still affects their growth because now there's something that's competing against it. And so what tends to happen is if someone comes in and sets the trend of lower rates, people have to follow suit and they have to actually lower down their margins just to compete.
That's happening with SoFi, with all their competitors raising rates, Apple coming into the business. A lot of these governments are actually limiting interchange fees, which is hurting Visa, MasterCard, all these. The total addressable market for global payments is going up at an extreme rate. I do think that there's a market for it. And who better than a company with 433 million customers? I think FedNow is this big boogeyman that I don't actually think will be rolled out as quick as people think. And I think it'll be a long while before, if it even does hurt PayPal. I'm still a believer.
Steve, you wrote an article on PayPal. Any thoughts on the overarching bull case for this company at this valuation?
I'm pretty bullish on the current market cap. I'm planning on starting my position next week on it. I mean, it trades at 13.38 price to free cash flow, which is super low.
Can you before you keep going, you use the stat a lot and you've explained it to me before, people in the chat as well. What is price to free cash flow and why is that a good metric?
I'm not going to say it's a good metric, but it is my favorite metric to look at because free cash flow is the hardest profitability line to manipulate because it is cash in minus cash out. Price to free cash flow is simply market cap divided by the free cash flow in the trailing 12 months is what I use. Okay, so the reason I use this plus equity is because God forbid the worst happens and you end up in Chap 11. Assets minus liabilities is your total equity on the books. That's what shareholders are left with in court. So that's my baseline. Then I take the multiple of a peer group of free cash flow. The peer group average is 16.6x. So right off the bat, PayPal is trading under the peer group average. And when I add the peer group average multiple to their free cash flow, it's 84.73 billion. Then I add the 19.85 billion in total equity, and I come up with my baseline of what I think the company is worth, 104 billion. Their market cap's 68 billion. There's a 36.6 billion differential. Trades at 35% discount. Shares have to go up 52% to get there. Not saying it's correct. It's how I establish a baseline to see if I want to do more due diligence into the stock and think things are going to stay steady or not. I mean, look, I'm fine buying a business that has minimal growth aspects if it's going to keep churning out that amount of free cash flow because you can do buybacks. And what happens when you buy back shares? You decrease the float, increase EPS if the income from operations stays the same or increases. I mean, this is a company where the analysts, not me, but if somebody brings up Seeking Alpha and goes to earnings, you'll see the analyst charts on this. They're expecting huge amounts of increases for their EPS.
This is from Steven's article, just going over
since 2017.
Yeah, growth since 2017. This is what the company has done. A lot of this is directly in 2020 due to COVID, but still, no matter how you want to, evaluate your stocks, any way you want to spin this company, it has done amazing growth and it's being priced as if it's going to be growing or not even growing. I mean, just staying stagnant and paying out investors. But I think it's not only going to be paying out investors, with large share buybacks, but also being able to grow because just the total addressable market for digital wallets and everything like this. And this is not even factoring in if central bank digital currencies or something are coming out, which I guarantee you PayPal will be a big player in hosting a lot of that money.
PayPal's consensus estimate, you have 41 analysts saying that the 2023 EPS estimate is $4.94. Then in 2024, you have 43 analysts saying it's going to be $5.68. And then the 2025 EPS, $6.46 from 16 analysts. I mean, that places the forward PE out to 2025 under 10. From a valuation standpoint, it makes sense. I don't know what the future is going to hold. Maybe their business crashes. I'd have to reevaluate. But right now, based on the numbers, this is a value play.
At this valuation, I think it's just people think that this is a dead company, and I don't agree. PayPal knows how to create sticky customers, and they continue to give large incentives for people to pay their bills through this, do all these different actions that make a very sticky customer. And you can see since the beginning of time, the earliest quarterly breakdowns that I've seen, which are 2017, they've always increased their average engagement per user. Sorry, I'm stuttering over my words today. But
can you guys believe 2 years ago this was a $300 stock?
And that's the other thing.
I'm not saying it's worth that. There was a big mistake.
No, but think about the psychology of that. People remember it there.
There was a massive step in management. Okay. I don't think that even at the height of COVID, it was worth $300. Problem was Dan Schulman made grave errors in assuming how large the company was going to grow during COVID. And their outlook, their guidance was so extremely large whenever that never actually came to fruition. The same thing with Shopify, right? They thought e-commerce was going to grow past lockdowns. That's what killed both Shopify and PayPal, both just extreme optimism.
I think they were on the top of the hill and they got complacent. And so now all these other competitors are chopping at the bit, which is natural, right? That's what happens. Like you get too confident. It happened to Intel. It happened to a lot of great companies where you get so high up there, you think that you can do no wrong. And then here comes a competitor that's working light with a much more, pronounced goal. They're not celebrating their stock price. They're celebrating their actual victory and success. So, I mean, yeah, it just leaves the door open for a lot of competitors. And the competitors came in, Cash App came in and ate a lot of market share. 5 years ago, I don't think anyone used anything outside of PayPal. I think PayPal had a near monopoly over payments like that, especially over the internet and everything else. I'm not so sure that they are in the same monopolistic position as they were in the past. So they don't deserve that kind of valuation.
I don't think payments is a monopolistic business. It was in 2001 when they developed it, but like, what would they have done to stop Zelle or Cash App or any of these other guys?
Well, that's the key, right? That's what management is supposed to do, whether that be through advertising, maybe that's through like providing consumers with a better experience so that this way no one even considers switching out of the PayPal ecosystem,
I completely agree with you. I think in before Dan Schulman in 2015, they even said it, like they were not innovating on their products at all. They were just trying to do global expansion and get new customers, and weren't actually building out the product. Dan Schulman came up and broke the company into a bunch of different segments, said, okay, it's time to re-innovate this product. Rebranded PayPal with this whole new logo, this whole new idea that they were going to come out with new products, savings accounts, interest, cards, everything. So, they broke this company down into three main segments, and now they're actually starting to have, not starting, I mean, they've been doing this for like since 2017, but global expansion still needs to happen. Like, for example, the PayPal that you guys have in the States is not the PayPal that we have in Canada. We don't have the APYs and the cards with MasterCard and everything like this. It's just not a possibility. And there are things like Kris said, I wish, like, how come they did not actually build a payment rail? Like, you don't think PayPal's large enough to build, like, to make a competitor versus Visa? I'm not saying they're the dominant figure that they once were, but I'm saying I believe the stock. I'm not saying the company is my favorite. I'm saying the stock is my favorite. Like, it's now just too cheap for me to not buy shares. The same way that I'm not the ultra fan of Meta, but it does get cheap enough. The users are not using PayPal as a peer-to-peer payment system. They use that for Venmo, which is still the largest one in America, which is also owned by PayPal. And then on the enterprise side, they do want PayPal. So either they're going to use PayPal checkout for the trusted brand for small businesses and keep the margins high, or they're going to use the exact same service that PayPal has, but unbrand it through Braintree. The total payment volume of PayPal continues to climb. They are a growing company while redistributing back to shareholders.
Banks are where tech was in November. So right now I am diversified in my bank holdings, but I think right now the banking sector is a very underappreciated, undervalued part of the economy. So I actually have reduced down my expectations and some of my growthier positions in growth big tech, which I think the valuations have climbed way beyond what was normal for their usual trading range, to the banking sector. It's not just about picking one company, but also about picking an entire sector that could be undervalued and then finding the gold mines between those. Because what happens is a lot of times the market will throw out good companies with an entire sector. And if you're smart enough, you can pick out some of those good companies, dude, you will do excellent.
So basically you're saying SoFi could be a great company, but still be at $5 by the end of the year just because the market is the market, whereas some of the other regionals could climb back to normal.
Yeah, they just have to perform baseline and they'll be back to where they were. SoFi has to perform. The banking is one of the best areas that you could be in long term because banks pay out really good dividends. So if you buy a stock at a very low price, you're not only banking on the capital appreciation, but you're also banking on the growth that you're going to get from the dividend appreciation also. So like imagine right now, 2008, 2009, you bought Bank of America or JP Morgan. You could have bought them at literally
Bank of America was trading like
$7 a share. And you would have not only would you got the capital appreciation for those next 10 years, every year Bank of America would have been paying you to be a shareholder. That yield would have been close to, like right now, based on that share price, is close to maybe like 15, 20% per year. I plan on holding a lot of these banks for 10 years plus because I know the yield right now, I'm getting a 7.5%, 8% yield on a company that's generating a ton of free cash flow, and their free cash flow is growing every year. I'm looking at 10 years worth of not just capital appreciation, but dividend appreciation also. So like I said, I think you have to be sector dependent, but there are times where the sectors become very overvalued and you should be ready to cut some too. Warren Buffett is buying up banks right now. Michael Burry buying up banks. Bill Gross buying up banks. Every single whale is buying up banks right now. So all I'm saying to you is just think about it. The sector itself is undervalued. So right now, in my opinion, you could take a dart and throw it at a dartboard that had nothing but financial names on it, and you'll still do better than the general market. You know, if you just invest in the thing, because there's a lot more price appreciation that's going to come once these rates start to go down. You know, so I would say in a year now, look at the index fund, look at the indexes in the financial side and the banks. Most of them will have recovered back to their mean again.
Banking is a requirement for the economy. It's never going away. The winners will change here and there, but I've been trying to sell Kris on one. I'm going to say right now, Citigroup. I mean, I called it before Buffett bought it, like a week before. Somehow I got lucky on that.
I did.
One.
I bought some Citigroup because Steven mentioned it. Yeah, the price to book, price to EV is just too good.
So
yeah,
you can grab a 4.5% dividend yield with them. They are a top 4 money center in the country, and their tangible book value, which is stricter because it strips out goodwill and the intangible assets, is $84.34. Their book value is $96.60. It's trading at $45.71. I mean, this thing just has not recovered yet.
The unknown for some of those banks like Citigroup, for example, I don't necessarily know why it's trading so cheap. And if something is trading so cheap, you can't just think that the market is delusional and you found something great. I mean, there must be reasons for valuations.
Well, the reasons were because two big banks collapsed and the market got stupid and threw the entire sector away.
Citigroup has been trading for half or 0.5 price to book forever. Unless you can articulate the actual bear case for why it's trading so cheaply, then you're missing something.
But
listen, sometimes Mr. Market gets drunk.
Yeah, no, I agree with you. The market can be dumb. I agree, but that would not be my first assumption. If I've done a lot of due diligence, then I go, okay, you know what? Then it's being dumb. But I think that's how you get caught with your pants down.
Tannor, I used to be like you a little bit in that I would try to find the reason why something is down so much that I would scare myself away from an industry. And then I realized people are stupid and human psychology just works. Human psychology is the biggest detriment to good investing. So if you just right now, when there's fear in the market, people will sell things at irrational prices.
Steven, it sounds like your favorite bank right now is Citi.
Yeah, mine is Truist Bank. Truist Bank, they're like the 6th largest bank in the country, even though everyone's like, oh, this is a regional bank. They have an insurance business that's like the 6th largest insurance company in the United States. They do primarily small business and small clients. They're like everywhere you go down south, you're going to see a Truist Bank because they're a merger between SunTrust and BB&T. They have a ton of revenue streams. They provide all sorts of products, whether that be credit cards, home loans, you name it, they're in it. So they're very well diversified. They're not your First Republic banks, which only cater to a small subset of the population, or Silicon Valley that only, did it with one specific sector. They're a very diversified bank. And anytime I say the name Truist to people, they don't know it because Truist is actually a brand new name, but they are an old bank. They're from like the 1800s. Okay, that's how far back this bank goes. Their price to book is in the 0.60. Their PE is a 6, which typically banks trade at a PE of about 10. So there's a lot of upside. That's literally, it's just all you need is Mr. Market to wake back up, and everyone's going to be like, wait a second, why didn't I buy this when it was undervalued? That's it.
All right, so these are the big 4: Bank of America, Wells, JP Morgan, and Citigroup. JP Morgan and Citigroup have the same exact LDR ratio. Lower's better. Citigroup has over 2x the equity on its balance sheet than its current market cap. And Citi's the only one that trades at a discount to tangible book value. It trades at a very large discount to regular book value.
But this doesn't send you warning signs? Because this is just red flag central to me.
How is this? The only way that it's red flag central is if you think that assets are worth pennies on the dollar.
For these easy metrics, every single institutional buyer in the world is looking at the charts that you're looking at and better. All I'm saying is if Warren Buffett, I know he made a small purchase in Citigroup because he's willing to take the risk, but if anyone could look at screeners like that and make easy bets on this massive discount versus the rest of the banks, he would have acquired 10% of Citi like that. And no other institution, you're not seeing Bridgewater or any of these companies that would love to hold banks touch Citigroup. Why is that?
I'll look into it this week. But to answer Tevis's question, it's not one favorite. Let's exclude SoFi because they are a bank. Excluding them, it's three that are my main. New York Community Bank, which is already run quite a bit, Citigroup, Bank of America, and now TFC. I looked into it after Kris recommended it, and it's, in my opinion, very solid.
I'm actually buying Zion Bank. The Mormon Church has had long-standing relationships with Zion Bank. They launder all their money through it. I mean, I don't want to say launder. Sorry, wrong word. They pass a lot of their money through that bank. And the one thing I know is their Mormon Church is very well capitalized. So I don't think they're going anywhere.
I will.
Bye, everybody.
See y'all.
Bye, guys.
Good night.